Let's dive into the markets now. I'm bringing Jeff Kleintop, Chief Global Investment Strategist at Charles Schwab. Jeff, always good to speak with you here. My mind right now is on earnings season. Do you think the market is right to completely ignore these earnings reports? We have dividend cuts, no more buybacks. I got GE out this morning saying it burned through $2.2 billion in cash. Now it's looking for another $2 billion in cost cuts. What the heck is going on here?
Yeah, there are some things to be focused on this earnings season, even though it is a bit of a look in the rearview mirror. None of these companies are proving pandemic proof, as we just heard a couple of names this morning that are suffering on results a little worse than many expected, given their businesses. But look, a lot of companies are looking to hoard some cash right now. They don't know how long this is going to be. We are on the cusp of these reopenings, but we don't know how fast they're going to proceed. We don't know how successful they'll be. So companies are really looking to hoard that cash and take guidance out of the, whatever guidance they had, take it out of the picture. And so that is a pretty negative picture for a market that's already rallied back on the idea that this will be a fairly rapid recovery, given that we're now maybe at peak lockdown.
You know, Jeff, is the market just simply too optimistic right now? We found out today our economy shrank more than expected by a 4.8% annualized rate. It's expected to get a heck of a lot worse in the second quarter. Why is this market continuing to be so resilient?
You know, the stock market is at a complete disconnect from the other markets. Take a look at the bond market. Yields are about as low as they've been during this downturn. Look at commodities. I know oil's bounced a little bit this morning, but they are pinned to their cycle lows as well. Yet stocks have rebounded pretty significantly. So I think there's certainly a bit more optimism, maybe a lot more optimism in the stock market around the pace and success of these recoveries, of these reopenings, I should say, that's not embedded in other markets. So there's a lot of skepticism across the rest of the marketplace not being seen in the stock market. So you have to ask, well, why? Why is that the case? Why are stocks where the optimism is being concentrated? And I think I just have to say, you know, it's interesting if you look at ETF flows, we have not seen the type of selling you'd normally expect to see in downturns from individual investors. That would normally kind of give you the next down leg and then be very slow to come back. And that hasn't happened this time. It's a bit curious, but I think many individual investors are focused maybe more long-term or maybe more focused on their personal health than maybe their financial health.
Good morning, Jeff. It's Heidi Chung here. So you're not the first strategist that we've talked to that has said that we're potentially going to see a W-shaped recovery. So at the end of this pandemic, can you give us a little more insight on what you mean by that W? Are we encouraged here, or are you encouraged here, that the recovery in China and South Korea seems to be on track at this point?
I am encouraged by that, and I'm not forecasting a W, but I do think it's a risk. We are watching these high-frequency indicators, things like we watched in China and South Korea, things like rush hour traffic, retail foot traffic from shopper track, you know, as that begins to come back a little bit here. Looking at air pollution for a gauge of manufacturing recovery, electricity use is a gauge of the service sector coming back online, and then, of course, having to watch these new virus cases every day. They have been successful. You almost say V-shaped recovery in China. They have not seen a further uptick in new cases, but we're now a couple of weeks past the reopening in Austria, and it looks like more of a slower recovery. Italy targeting May 4th, Germany and France have different dates at which they're beginning to reopen. So we're going to need to watch this on a real-time basis. I think that hopefully there are some signs that they may be successful and not lead to another spike in cases that would give us that W. But it's early to make that assessment, but the stock market seems fairly convinced.
Jeff, that's pretty clever to watch air pollution in China. I'm actually writing a note to go back and check that myself. My question is, do you think we're in a new bull market here?
I think we're on the cusp of beginning one. Has one already begun? I don't know. We like to say, you know, bottoms are a process, not really a day. So I think maybe a little bit more evidence needs to come into play before we can declare the bear market over to new bull market intact. But I do think that new leadership usually comes with a new bull market. And it's interesting to note that we've seen value stocks lead the recovery so far. I don't want to dismiss what we've seen in some of the tech names, but look, energy and materials have been the leaders, the two best performing sectors off the low. I'm not sure how sustainable that is given the lack of demand for production and transportation right now. But it's interesting to note given the fact that the entire last cycle was led by tech.
Jeff, what are your expectations from the Fed today? We don't expect them to move, of course, on interest rates. They're already at zero, pretty much. We're not going to go negative. At least many people don't believe we will. So what do you expect Jay Powell to actually say later today?
I think he's going to say that the Fed stands ready to do more if necessary. I think he's going to probably be forced to say something about how they still don't believe negative rates are likely, because, of course, we've heard Coach Lakota and others that it's a possibility. But I think more importantly, the Fed may just say they're ready and they're watching the data very closely. He may talk a bit about, and this might, result in a tweet from the president, that maybe the reopenings should be very cautious and very slow to ensure a successful recovery. We'll see whether he chooses to delve into that territory.
Jeff, let me get back to something you just mentioned, value versus growth. I'm starting to see a rollover. Some of these big cap tech stocks like Amazon that have led us the past month. Is that a red flag to you?
No, because I think we need new leadership. I think that many of those leaders have done a lot. Their movement, their valuations, the expectations around them are probably being ratcheted down to a greater degree. I think we need to see leadership from bigger groups that haven't participated in maybe a decade, like financials. A big group here like to see the yield curve steepen up a little bit more and begin to lift that sector. I think that is kind of a second wind we would need to really see this thing get going.
And Jeff, what about oil? I was looking at some of the oil ETFs. It surprises me to see they have done reasonably well despite all the volatility in oil. Do you like the oil space at all as some form of value play?
We are neutral on oil right now, and that's kind of a big call, kind of a contrarian call in and of itself. The oil stocks tend to move on not on the front month contract, 24 month contract. They tend to look out a bit for prices. Those are still over $30, and I think the expectation is they've got the liquidity to kind of make it through this near-term environment. So if you're looking past this, wherever this recession ends and the recovery begins, it's probably within the next 2 years. So they're looking through that and have the cash flow to hang on to it. I think investors are encouraged that there might be some value there, but I wouldn't get too optimistic. Given longer, it could take quite a bit longer for demand to come back in a number of industries like cruise lines and air.
So, Jeff, speaking of value, where do you see it right now, at least in the short term, for investors who still feel comfortable being actively in this market?
It's actually maybe not in the U.S. If you take a look in Asia and you take a look at Europe, those markets have lagged for a long time, yet they are showing some early signs of success as they reemerge from the shutdowns. Their shutdowns were total and successful, unlike maybe what we saw in the U.S. We're also seeing, signs of increasing stimulus there. They've got a broader social safety net that actually has meant we've seen far fewer layoffs, maybe 1 to 10 layoffs that we're seeing in the U.S. And that might mean a more rapid recovery. So, as I look at some of the sectors and industries, European countries look more attractive to me than what I'm seeing in the U.S.
But Jeff, bigger takeaway here. This is the stimulus-led rally in Europe, in China, in the U.S. At what point do you think some of these stimulus efforts, these governments start to pull back on some of these things? Is it off the table for this year, and those pullbacks are in 2021?
Maybe, I don't know. Do we get the pullbacks? It's interesting. Remember the 2010s were supposed to be the decade of austerity after all that 08 and 09 stimulus, and they weren't. So I don't know when that's going to happen. I worry a little bit that all the stimulus that's chasing the markets up now turns into a big heavy debt burden and weighs them down later in terms of overall. So it could make this downturn shorter. It could make the recovery miserable. We'll have to see.
All right, let's leave it there. Jeff Kleintop, Chief Global Investment Strategist at Charles Schwab. Always good to speak with you. Stay safe.
Thanks, you too.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.